Good day, fellow investors. SP Global is a wonderful business. And wonderful businesses usually are 100 beggars, and that is exactly what the stock delivered over the last 40 years. And similarly, another factor that makes a great business is Buffett owning, in this case, more than 50% of Moody's. And if we go at the worst possible point for rating agencies, 2010, we listened to Berkshire's annual conference. Warren Buffett says the ratings agencies have had and still have, under current conditions, an incredibly wonderful business. I mean, it takes no capital at all. The pricing power is significant, and we'll see later 40–50% margins, and certain parts of the world feel they need rating agencies. And there is another factor that we'll discuss through the video, which makes the key of the wonderfulness of this business. With the analysis, first and foremost, it is the stock market. The business represents financial markets, and if financial markets grow and everything looks great, then also the business will grow even faster. Earnings will grow even faster because there are great margins, great profitability. They are doing buybacks, and another signal of a great business, they raised the annual dividend for 52 consecutive years. That's even one more than Archer Daniel Midland's that we have recently discussed. Issuance volumes are going up. There is more and more debt in the world, thus more need for rating agencies. And then, of course, AI, everyone is discussing AI. If you can turn your stock into an AI stock, it can only boom. That's how the market works now. For now, everything working great, huge margins, growing margins. The estimations going forward are for normal GDP global growth, a little bit slower in the US, stable oil, and stable growth in issuance. But if you look at total debt maturing over the next years, you can see that we are in a credit world, and that is also just going up, which means that's just a positive for the company. Issuance, there was an explosion, of course, in this year, so it will be hard to compare the next year, but they still expect stability, earnings per share of 15, 14. If you look at not GAAP metrics, 17 earnings per share, growing, huge operating profits. But that is going from a great year into an even better year. If I look a little bit, okay, when was the bad situation? Last time, 2022 was a declining market, and you can see in a declining market, revenues decreased for but the company, given the quality, given the great business, still had profitability, still made money, even if everything declined compared to the year earlier. But you can see here, despite everything declining, profitability remained very strong. And they would really need a big crash for profitability and everything to go down, but I have checked that too. And if you look at what happened from 2008 to 2011, their revenues did fall 40%. Profitability, surprisingly not, which is very interesting, but now, given the boom here, if revenues decline 40% on a market crash, likely profitability will still decline. However, it would still remain, I think, profitable. Now, when it comes to the business, everything great. Markets, the Fed will print money, markets over the next 5, 10, 20 years will expand, everything looks great, except the tiny detail of the price-earnings ratio, 43, and then we can ask ourselves, is it worth paying a P ratio 43 for such a wonderful business? And you can see here how when there was the scare, the stock really crashed, and if there is just 1 year of such a scare, then you might even see it lower, but we don't know whether the market will just continue to grow and then we see it lower here. That's impossible to know. If I look at the conference call, AI, they will implement the tools, so a lot of potential there. So let's check. Let's see whether AI is a threat or is a benefit for a company. Analyze SPGI stock, and then we go. So we have a stock price from ChatGPT, revenue growth, nothing crazy, just a short analysis there. I can ask, is the stock a buy? And then it gives me the bullish factors, the bearish factors, high valuation, interest rate sensitivity. Higher interest rates could impact the credit rating business, which is a major revenue source, and market volatility. So you need to understand that yes, it is a great business, wide economic moat, dividend growth, positive analyst ratings, everyone wants it up 10% alongside the market. But there are also risks. If you're a long-term investor looking for a stable, high-quality business, then SPG is a solid buy. However, if you're concerned about the short-term market fluctuations or high valuation, it might be worth waiting for a better entry point, and then it can go on comparing, etc. But when it comes to this, is it a threat or a benefit? Depends on how big the moat will be and how other things work. And of course, the key factor that makes this a wonderful business, which will come in a second. Looked a little bit at the questions on the conference call. So things will just normalize a bit, but they are improving the business, so everything okay. This is the question on the threats and everything related to generative AI. They see it as a benefit, of course, like every other company. But when did Warren Buffett buy Moody's first? And he bought in 2000 for 499 million. He bought 15% of the company. Of course, that's a 50 bagger now for him, but if he paid 500 million for 15% of the company, that's 3.5 billion. That's a P ratio of 10. And you are now paying 40 for something Warren Buffett paid 10 for. That's the key discrepancy there, and also the key factor here. If the price was 4 times higher, the return would not be a 50 bagger, but just a 10 bagger. Still good. Don't get me wrong, still good, but you have then also accept the potential volatility when it comes to buying here and when things look uncertain for a while. That's the key risk there. But why is this a great business? Here, Warren Buffett keeps explaining how they don't use any attention to ratings. We don't think we should farm out outsource investment judgment. So why did he buy the business? Well, because it's not a business we rely on, but we do recognize that if the social model doesn't change, it still remains a phenomenal business. And if we look at rating agencies from 2007 to 2009, if you look at the rating for Greek bonds, it was stellar, excellent ratings. Buy that bond for your pension fund. And then it went almost broke. So why are people still following these investment rating agencies? Because they offer the key factor when it comes to investment. If you manage someone's money, you look at the rating of the agency, you invest that money. If it goes bad, it's not my fault. It's not my fault is the key selling point of the business. It will be there forever when it comes to the investment environment. If a pension fund loses billions of your money on crazy stock prices, on this, well, Wall Street's rating is we give it a buy. They said it was a buy. Credit A rating, even if then it goes bankrupt, it's not my fault. That is the key and the huge moat the business has. Warren Buffett takes his own fault. When I make a mistake on my research platform, it's only my fault, nobody else's. But S&P 500 solves that key problem for the investing environment, and that's why they are a great business. Thanks for watching. We'll keep looking for the same businesses, but as Buffett did, at P ratios of 10.